Hey there, Michael here. If you're thinking about investing in apartment buildings, there are some important mistakes you'll want to avoid. In fact, making just one of these mistakes could end up costing you a lot of money. So, let me ask you this, are you ready to learn about the top 7 mistakes to avoid when investing in apartment buildings? Great, let's get started. Introduction. Investing in apartment buildings can be a lucrative venture, but it's not without its challenges. In this article, we'll discuss the 7 mistakes that people commonly make when investing in apartments. By avoiding these pitfalls, you can increase your chances of a successful and profitable investment. Mistake number 1, failing to do proper due diligence. One of the biggest mistakes you can make when investing in apartment buildings is failing to do proper due diligence. What is due diligence, you ask? It's basically a thorough investigation of the property's financial, legal, and physical condition. Without doing your homework, you might end up with a property that has hidden issues, such as zoning violations or costly repairs. This mistake can be easily avoided by hiring professionals, such as real estate attorneys and inspectors, to help you evaluate the property's condition. They can help you identify potential issues and ensure that the property meets all legal requirements. It's also important to consider the property's location and market conditions. You'll want to assess the local rental market to ensure that there is demand for rental units in the area. You should also evaluate the property's proximity to amenities such as public transportation, schools, and shopping centers, as these can impact the property's desirability to renters. Mistake number 2, underestimating repair and maintenance costs. Speaking of repairs, another mistake to avoid is underestimating repair and maintenance costs. Even if a property seems to be in good condition when you buy it, things can quickly break down or wear out, especially in a large building with multiple units. That's why it's important to budget for ongoing maintenance and unexpected repairs. To avoid this mistake, it's important to work with experienced contractors and property managers who can help you identify potential maintenance issues and estimate the costs of repairs. You should also set aside a contingency fund to cover unexpected expenses that may arise. A general rule of thumb is to budget at least 1% of the property's value per year for ongoing maintenance and repairs. For example, if you purchased a property for $1 million, you should budget at least $10,000 per year for maintenance and repairs. It's also important to keep in mind that different types of repairs and maintenance will have varying costs. For example, cosmetic repairs such as painting and carpet cleaning are generally less expensive than major repairs such as replacing a roof or fixing plumbing issues. By understanding the different types of repairs and their associated costs, you can better budget for ongoing maintenance and repairs. Mistake number 3, not considering location carefully. Another mistake to avoid is not considering the location carefully. Location is crucial when it comes to attracting tenants and keeping them happy. Factors to consider include proximity to transportation, local amenities, and crime rates. A bad location can lead to high vacancy rates and low rental income, while a great location can attract high-quality tenants and increase the property's value over time. When evaluating a property's location, it's important to consider the neighborhood's demographics and overall economic health. You'll want to look for neighborhoods with stable or increasing property values, low crime rates, and high quality of life. Properties located in up-and-coming neighborhoods can be particularly attractive, as they may offer a good investment opportunity with the potential for growth in the future. Finally, you'll want to consider the local amenities in the area. Renters often look for properties located near shopping centers, restaurants, parks, and other attractions. These amenities can make the property more attractive to renters and increase its overall value over time. Mistake number 4, overestimating rental income. Next up, overestimating rental income is a mistake that can lead to disappointment and financial strain. It's important to make realistic projections based on factors such as market trends and the condition of the property. Overestimating can also lead to taking on more debt than you can handle. When projecting rental income, it's important to consider several factors, including the current market conditions, competition in the area, and the condition of the property. For example, if the property needs significant repairs, it may be more difficult to attract tenants and command higher rental rates. It's also important to factor in additional expenses such as property taxes, insurance, and property management fees when projecting rental income. These expenses can have a significant impact on your bottom line and should be taken into consideration when making financial projections. By making realistic projections about rental income, you can avoid taking on more debt than you can handle and ensure that the property generates enough income to cover expenses and provide a solid return on investment. Overestimating rental income can lead to disappointment and financial strain, so be sure to conduct thorough research and make conservative projections. Mistake number 5, Ignoring the importance of property management. Another mistake to avoid is ignoring the importance of property management. Property management is a critical component of successful apartment building investing. It involves everything from screening tenants and collecting rent to maintaining the property and handling repairs. Without effective management, it can be difficult to attract and retain tenants, leading to high vacancy rates and lost income. One of the key factors in effective property management is having a clear plan in place. This includes defining responsibilities and roles for property management staff, outlining policies and procedures, and establishing clear communication channels for tenants and staff. By having a well-defined plan, you can ensure that everyone is on the same page and working towards the same goals. Effective communication with tenants is also crucial for successful property management. This involves not only being responsive to tenant requests and concerns but also proactively communicating with tenants about policies, procedures, and upcoming maintenance or repairs. By keeping tenants informed and engaged, you can help build a sense of community and reduce tenant turnover. Mistake number 6, overpaying for the property. Overpaying for the property is a mistake that can lead to negative cash flow and difficulty recouping your investment. Overpaying for an apartment building is a common mistake that can have serious financial consequences for investors. When you overpay, you're essentially starting your investment with a significant disadvantage, and it can be difficult to recoup your investment, let alone generate a positive return. One of the biggest challenges in avoiding this mistake is determining the fair market value of the property. There are several factors to consider, including the property's location, condition, age, and potential for rental income. You'll also want to consider the current real estate market conditions and any unique features or challenges of the property. Another important step is to avoid letting emotions or pressure from others influence your decision. It can be tempting to get caught up in the excitement of a potential investment or feel pressure to act quickly to beat out other buyers. However, it's important to remain level-headed and focused on the numbers. Remember that investing in an apartment building is a business decision, and it's important to approach it with a clear and objective mindset. Mistake number 7, not having an exit strategy. Finally, not having an exit strategy is a mistake that can lead to being stuck with a property that isn't performing as expected. Not having an exit strategy is a mistake that can lead to significant financial consequences for investors. Without a plan for how you'll eventually sell or dispose of the property, you could find yourself stuck with a property that's not performing as expected, or that no longer fits with your investment goals. One of the main reasons why having an exit strategy is so important is that circumstances can change quickly in the real estate market. For example, you might find that the rental market in your area has changed, making it difficult to attract tenants or generate the income you were expecting. Or, you might need to sell the property quickly to free up capital for other investments or personal expenses. When developing your exit strategy, it's important to consider both short-term and long-term goals. For example, you might plan to hold onto the property for a certain number of years before selling, or you might set a specific target for return on investment. You'll also want to consider any potential challenges or risks that could impact your ability to sell or dispose of the property, such as changes in the local real estate market or unexpected repairs. Conclusion. In conclusion, avoiding these mistakes is crucial when investing in apartment buildings. By doing your due diligence and having a solid plan in place, you can increase your chances of a successful investment. Remember, investing in apartment buildings can be a great way to build long-term wealth, but only if you approach it with careful planning and a realistic mindset. If you found this helpful, please subscribe to our channel Brainstorm with Michael for more informative content on investing and real estate. Thank you for watching, and please don't forget to hit the like button and share this video with your friends and colleagues.